Hi, Maria.
Hi, how are you?
Good. Just you and me so far, huh?
Yep.
All right. We'll give it another minute or so and probably just get going into the lecture, okay? We're up to chapter 6. All right. I guess we'll get started, Maria, okay?
Okay, sounds good.
Yeah. Okay. Do you see the slides, Maria?
Yeah, I do.
Okay. We're ready to roll. Cash fraud and internal control. This lecture is not going to have that many numbers in it, but we're going to be talking about how you can protect your assets, specifically cash. Okay, cash. And we're going to talk about something called internal controls and the purposes and principles of those. Internal controls are the policies and procedures that you have set up to protect your assets, ensure the reliability of your accounting, maintain your company policies, promote efficient operations. Internal controls. Sarbanes-Oxley Act. Let's talk about this briefly. We might have mentioned it in past classes. This is the law that was passed about 25 years ago in the wake of the Enron scandal, which was the largest bankruptcy due to accounting fraud in American history. It requires, Sarbanes-Oxley requires that managers document and address the effectiveness of all the internal controls. This act brings the president of the company and the chief operating officers into play. They used to be able to say, Maria, oh, I'm not the accounting guy. I don't know anything about the numbers. Those days are over. That's no longer a defense. Sarbanes-Oxley says you have to attest that you know what the statements are about, and you want to talk about your internal control process. Committee of sponsoring organizations, just briefly, ingredients that add quality to the accounting system. Control the environment, the risk assessment, control activities. Let's see where they go from here. Principles of internal control. Internal control principles common to all companies. You establish responsibilities. That's pretty important. Who's responsible for opening the mail? Who's responsible for filling out the bank deposit? You establish clear, separate responsibilities for different tasks. And you maintain the proper records. And you might even bond key employees. Bonding an employee. You might find this interesting, Maria. You hire a person, you're about to hire a person into a very significant and sensitive position where they're going to control a lot of money for you. You trust the person or you wouldn't have hired them, but you can go a step further and get an insurance policy called a bond, which says that if this guy steals $1 million and runs off to Mexico, the insurance company will make you whole again, bonding an employee. And they talk about separating record keeping from the custody, divide responsibilities. We're going to talk a little bit about that, and technological controls, passwords on computers, perform regular independent reviews. Internal controls, establish responsibilities, know who's assigned to what. Every person should know exactly what their job is. Over time, people might lapse into helping another person and maybe they start doing something that can cause a little bit of risk for the company. Task assigned to one person, and then you know who's at fault. Okay. Internal control, maintain records. Obviously, you got to keep up with maintaining records, and it helps the managers monitor the company's activities. That's why we have detailed records like a general ledger and the chart of accounts, pre-printed forms of different kinds that are pre-numbered is important. Invoices are always going to have an invoice number on them. And that way, at the end of the month, you can say, okay, our first sale of the month was on invoice 27, and the last one was 99, and you account for all the invoices in between. And you computerize when possible, right? Internal controls, insure assets and bond people. Assets should be insured against losses. Well, that's pretty common sense, huh? You have a big factory building, of course you're going to have an insurance casualty insurance policy of some kind. Bond employees are going to handle cash, which is that insurance policy we just referred to. Separate record keeping. What's this all about, huh? Separate record keeping from custody of assets. Person who controls or has access to assets should not have access to the accounting records. A little bit of an example. You may schedule a physical inventory, and in that inventory are items that are not that expensive and items that are very valuable. Well, if possible, you want the people who are counting that inventory for you not to be really familiar with which is the real expensive stuff. In other words, you don't want to tempt people. It reduces the risk of theft or perhaps waste. By keeping things separate, by saying that you, Maria, you're responsible for this and I'm responsible for that, employees would have to collude. They'd have to get together and agree in secret to commit fraud under that kind of control. If employees want to collude and steal money, they can do it, and there's not much you can do about it. So that's why you must set up these decent controls. Divide responsibilities. Responsibility for a transaction should be divided between two or more people. It ensures the work of one person acts as a check on the other. Separation of duties. You have one person who opens the mail, and then maybe another person who takes the checks and fills out the deposit slip. Another person records those checks into your general ledger, and another person maybe prepares the bank reconciliation. That way, you have to have four people get together to kind of cheat you. You put everything under one person, you're going to have a problem. And I hope I'm not repeating myself, Maria, but there's a story I always tell in this area about the Santa Barbara Police Department, where they hired a woman out of high school, and she did very well over the years. She got promoted a few times and got a little education, and eventually she was a trustworthy employee. And they said, okay, you're in charge of the computer system, and you're in charge of taking the monies we receive for traffic fines and entering them in the system. Well, this person was a good person, but the temptation was too much. What she saw she was able to do is when you got a parking ticket and you sent that $40 or whatever it is into the city, she would take that parking ticket and put it in her bank account. And because she also had control of the computer system, she would just delete it like it didn't happen. And this went on for quite a while before she got caught and went to jail. Time clocks, for the employees, obviously, scanners can be useful. And perform regular and independent reviews, huh? Bring in the auditors from outside. The outside auditors are going to come in once a month and go through your financial reporting. And among the things the auditors do is not just prepare adequate, correct, hopefully financial statements, but they're going to test your internal controls. And if they see a problem, they'll bring it to your attention. All right, we got more non-number type stuff, Maria, so hang in there until we get into something a little more interesting, shall we say. Technology, fraud, and internal controls, reducing errors, training, testing, separation of duties. Let's see. There are limitations to internal control. Human error, it happens. Carelessness, misjudgment, confusion, an employee doesn't know what they're doing. That can generate some losses for the company that no internal system is going to handle. And then human fraud, intentionally defeating the internal controls, huh? The human triple threat. Here we go. That's a football term. It used to mean a guy who could punt, pass, and run. Triple threat: opportunity, financial pressure, rationalization. If you have weak internal controls, you're giving somebody an opportunity to steal. You can tempt them. And an otherwise good person might have some financial problems at home. They're living from paycheck to paycheck. If they see they can knock off some assets, get away with some cash, they can do it. And they'll often rationalize it by saying, oh, it's just a little bit. Everybody does it. The triple threat: opportunity, your internal controls take care of that. Okay. Cost benefit principles: cost of internal controls must not exceed their benefits. We're not going to buy a $10,000 safe to put away a $200 petty cash account. Okay. We're going to lock the petty cash in our desk drawer when we go home. That might be good enough control. Cash and cash equivalents and how to report them. An effective system of internal controls that protects cash and cash equivalents should meet these guidelines. Handling cash is separate from the record keeping. Like we just said, the person who counts the money when it comes in, they are not the ones who fill out the bank form, and a third person maybe takes the money and makes the deposit. Cash disbursements, doomed by check, obviously. That's common sense. And cash receipts, you promptly deposit them in the bank. You should do it every day. I'm no expert, but I believe like fast food places, they deposit their funds every night. That way, they don't have a ton of money sitting around for somebody to steal it. If you're doing it once a week, you run the risk of an employee or a former employee who knows when the money is at its peak coming in and rob the place. Cash equivalents, and liquidity. Cash and similar assets are called liquid assets because they can be readily used to pay bills. Liquidity is a term meaning the ability to turn an asset into cash. Cash is liquid. Accounts receivable, that's pretty liquid too. Your inventory, a little less liquid, but you'll be able to turn it into cash. What is cash, huh? We know it's currency and coins. We know it's checks, and we know it's checks, money orders, direct deposits. Credit cards are cash as far as I'm concerned. Credit cards are cash. Cash equivalents, short-term investments, typically less than 3 months, readily convertible to a known cash amount, close to maturity date. It's not going to change. You put money in the bank and you sign up for a 1-year certificate of deposit. That means you're not allowed to touch the money for an entire year without incurring a penalty. Well, you might put the money in for 3 months, where you have to keep it there for 3 months, that's considered liquid, just like cash, because the money is so quickly available. Cash management, the goals of cash management. Plan cash receipts to meet the cash payments when due. Keep a minimum level of cash necessary. Yeah, yeah. You maybe empty the cash register a couple times a day if you're a store or something like that. Effective cash management involves applying these strategies. Encourage collection of receivables. Duh. That's pretty obvious. Delay payments of liabilities. In other words, you want to collect the cash as soon as possible and pay it out as late as possible if you get away with it. I worked for a company that moved me up here to Santa Barbara a long time ago, and they were very, very tough. And my mandate was I had to collect cash in 45 days and pay our vendors in like 90 days. Do you know how hard it is to run a business when you're paying in 90 days and people are cutting you off? They're refusing to ship to you. It was a terrible act to juggle. And keep only the necessary assets around, and you do some planning. Having too much cash is not necessarily a good thing. Invest the excess cash. You got a bunch of cash lying around, invest it. Do something with it. Apply internal controls. Oh, internal controls again. To cash receipts and payments. None of the people involved can make a mistake or divert cash without the difference being revealed, huh? So what do we have here? We have a sales department. They sell something, the cash comes in, you have a cashier, that's a different person. The cashier does something, maybe fills out the deposit slip, then a supervisor looks it over. The more people involved in the process, the better, without overdoing it. Oh, we actually get to something like a journal entry, huh? Let's look at this. Sometimes errors happen. Sometimes errors in making change, say, are discovered from differences between the cash and the cash register and the record of the amount of cash receipts. That can happen. I don't know if you've ever worked at a place where you ran the cash register, but at the end of the day, you might be a little bit off. If a cash register's total shows 550, that's what you're seeing on the tape, the cash register tape. But you have $555 actually in the till. Well, it means that you came up with $5 too much money. Your sales are still going to be recorded at whatever is on the cash register tape. The difference between that and what's in the cash register physically is going to give you, in this case, a gain called cash over short. Cash over short is the income statement account to record these small differences that pop up now and then on petty cash as well as, say, a cash register. What happens if you're short? Here you go. If the cash register shows that the sales were 625, the adding machine tape shows us the sales was $625. That's how much we're supposed to have in the cash register. But we only have 621. Well, we lost $4 somehow. Probably never going to figure it out, but we lost $4 and have to recognize the loss. And we do so by recording again the sales from the tape. The cash is the cash. What's ever there, we have to debit cash. And here we debit that income statement account, which is a loss, an expense. Cash receipts by mail. 2 people are assigned the task of opening the mail. I don't know about that one. The cashier deposits the money. The record keeper, the bookkeeper records the amount in the accounting records. You get the idea? Separate the duties. Make it hard for someone to steal. Control of cash payments is kind of important, huh? As most large steps are from the payment of fictitious invoices, keys to controlling cash payments. Ensure you're making all your payments by cash, obviously. Limit access to the checks, except those who have the authority to sign them. Your checkbook, your checks should be locked up just like cash, and they should only be removed and brought out into the office area when it's time to run the checks. So the person who's going to run the checks is going to be different than the person who mails them out. You get the idea again, different responsibilities, different people. Cash budget. This is an important internal control. It's an accounting report. You project your cash receipts and cash disbursements. Company I worked for a long time, we called it the short range estimate. At the end of every month, after we closed, rather, I guess at the first week of the new month, we had to readjust our budget and see where we were going with the cash. That's another way you can control things a little bit. Voucher system, I'm not going through that. That's old fashioned stuff. Explain and record petty cash. Petty cash. It's used to pay little tiny things that pop up. Maybe a shipping fee. Maybe the FedEx guy knocks on your door and he's got something and you have to pay a COD of, say, $5. Well, you're not going to tell the FedEx guy to come back in a couple of days when you run your checks. You want to have some cash on hand to handle these little things, very minor repairs. Somebody lost 50 cents in the soda machine, that type of thing. So we're going to set up what's called a petty cash account. It's just a couple $100 in a typically in like a recipe box or a little box of metal box of some kind with a lock on it, and it can fit in your drawer to lock away. Establishing a petty cash fund. Well, we start by saying that you're the petty cash person, Maria. We're going to start and we're going to hand you, in this case, a check for $75. It's going to be made out to Maria. You're going to go to the bank and cash that $75 check, bring it back, and put it into the box. You're going to come back with a couple of 20s, a 10, whatever, 5s, some coins. Excuse me. So what we're doing is we're setting up a whole new cash account. So we have to debit something called petty cash and credit the regular cash to establish a petty cash fund, okay? Petty cash. Now, during the month, people are going to come to you with these little tiny things that they hope you can pay right away. For example, here, tile cleaning. You had a problem. You came into the office one day and there was damage from a storm or a little thing, not a little thing like a storm. But here they paid $46.50 for tile cleaning. On November 5th, they had to pay maybe a UPS fee. Something was delivered for $5. They had to run to the store and to spend $4.75, maybe for a couple of pens or something. The point is, the petty cash operator is going to keep track of these by filling out a little slip, having the person who's going to be paid sign that slip, and then put the slip back in the petty cash box for reconciliation at the end of the month. Petty cash. And by the way, you see that $46.50? There's no way I or anyone would approve that big a disbursement when you've only got a $75 petty cash fund. So it looks like they've spent $71.30. That means that they should have, I guess, what's the number? $3.70 left in the box. So let's see what's going on here. Cash payments report is used to make the journal entry. Debit all the expenses and credit cash. During the month, you have all these slips now, these little tiny petty cash slips. You take them out and you sort them out and you prepare the journal entry. So we have miscellaneous expense, we have inventory, delivery, and office supply. And here you go. Here's the journal entry. We've got miscellaneous expense, debit the inventory, debit delivery expense again, or not again, the first time delivery expense, and debit office supplies, $71.30. You are going to give that perhaps to the bookkeeper or someone in accounting, and they are going to record this journal entry and schedule and cut you a check for $71.30, Maria, and send you back to the bank and start all over again. Okay. To increase, remember they had a $75 petty cash account a couple of slides ago. Now they decided, man, that's not much. We need 100. So they're increasing the petty cash. If you increase it, you debit 25 to petty cash and you credit cash, or you can reduce it from 75 down, I guess, to 55. You will never debit penny cash otherwise. The only time you debit or credit petty cash is when you set the fund up at the beginning, and if you change the balance. If you decide that we need $100 more, now you debit petty cash. Otherwise, everything runs through the cash account. If a petty cashier fails to get a receipt, and that can happen, or overpays, you're going to find yourself out of balance. Petty cash payments report plus the cash left in the account are supposed to equal $75 or whatever it is. Here, we now have a 100, I guess it's a 100, I can't read that. 180, 175. You had hold on one second. I can't even see that. Miscellaneous expenses were 178, but the cash you came up with was 185. Cash was 185. You're over short $7. You debit, in this case, the cash over short. Okay. Now we get into some accounting type things, huh? Basic bank services. Well, we'll go over this little section pretty darn quick, and then we'll get into bank reconciliations. Bank services, huh? Bank accounts, checks, bank statements, all kinds of good things. I think you know what a deposit ticket is. I'm going to assume the class knows what this is, from depositing their paycheck, perhaps. If they don't have direct deposit, you fill this out, you bring it to the bank. If you're doing it for a company, you want one person to process the checks. You want someone else to take the money to the bank. Different people get involved. Deposit ticket. I trust we all know what that is. Deposit slip. I bet you know what a check is, huh, Maria? Huh? Used to withdraw money from the bank. And we know what a check is. I don't think I'm going to go into any detail on that. Check is a check. It's cash. A check is cash. Let's look at a bank statement, though. Usually once a month, the bank sends each depositor a bank statement showing the activity in the account. This is a crucially important internal control we're going to review. Preparing the bank reconciliation. So let's look at the bank statement. You are always going to see on the bank statement the date and everything. You're going to see the beginning balance, which is the ending balance from last month, okay? The beginning balance, less any checks you wrote, plus any deposits you put in to the ending balance. And here is the detail. Here is the detail of the checks and debits right here. We add these checks up. They come to $723. We add these guys up, it should come to 1163. What the bank reconciliation is all about is we're going to go through every single one of these numbers and quickly compare it to the general ledger. Okay, $375 reduction in our account. That's a check. We see that we have that 375 in the general ledger. We cross it off. And we're going to do that for all of these items. And what you're going to find is that inevitably, there are things that the bank has not recorded yet that we have, and vice versa. The bank has recorded things we don't know about. So we're going to take care of these, what are called reconciling items, okay? Prepare a bank reconciliation. And I hope they give you a lot of bank reconciliation type problems on your homework, okay? What is a bank reconciliation? A bank reconciliation is prepared once in a while to explain the difference between the cash that you have on the bank statement and the cash balance on the company's books, otherwise known as the checkbook, huh? And when you get that bank statement at the end of the month, the bank statement might say you have $50,000, but your records may say you have 60,000 in your checkbook. Does that automatically mean something's wrong? No, absolutely not. These differences are normal and they're due to timing, okay? So what are we talking about? We're going to talk about deposits in transit, outstanding checks. Deposits in transit, outstanding checks. Very simple. A deposit in transit is a check we received from a customer that we just mailed to the bank. We deposited the check into our records on October 31st, put it in the mail in this example, and it took 3 or 4 days to get to the bank. In the meantime, the bank statement for the end of October arrived. So the bank doesn't know that we have this $5,000, say, recorded. We have to then account for that on the bank reconciliation. Add not direct deposits, but add deposits in transit to whatever the bank balance is. Let's understand what outstanding checks are. Outstanding checks are checks that we wrote the company that simply have not been cashed yet. Not cashed yet. This happens all the time. You have a salesman, and maybe he took somebody out to lunch, a potential customer to lunch, and he spent $30. And he turned in his receipt, and the company wrote him a check for $30, and the salesman stuck the check in his drawer at home, and he kind of forgot about it. Well, the bank doesn't know about that, so we have to subtract that. An outstanding check, a check that has not been cashed because it's on the way to the bank, or whoever got paid has not taken it to the bank. We're not going to talk about bank errors. Banks don't make the errors. Companies make the errors, okay? Now, on the other side, you have a balance from your records, right? We're going to start with the book balance, general ledger balance. And we're going to look at the bank statement and pick out anything we see on that bank statement that we did not know about. What are we talking about? Well, maybe we earned interest. We don't know that until we get the bank statement. We're going to do that. We're going to subtract bank fees. And here's a good one we hate to see, but it happens. NSF check, non-sufficient check. That's a check we received from a customer. We added it to our records, presented it to the bank, and we find out at the end of the month the check was no good. It bounced. NSF, non-sufficient funds. The check bounced, if you know what I mean. No good. And then you could have add or subtract book errors. The company can make an error. Maybe we recorded a check for $189, but it was actually written for $198. That difference we may not know about till we get the bank reconciliation. So bank reconciliations are super important. I think when we're talking these internal controls about the separation of duties, the bank reconciliation, super important. You do it every month, you're giving yourself some comfort. And this is the template. I wish they showed this a little better than they do in these slides. The balance of a checking account reported on the bank statement rarely, I'm going to say never, equals the balance in the depositor's accounting records. So we have to take the balance per the bank and the balance per the general ledger or checkbook and put in the items that comprise the difference. Let's start with the bank side. That's the easy one. All you have to remember is the beginning cash plus deposits in transit minus outstanding checks equals what's called your adjusting cash balance, okay? Maybe a problem in your homework, you're going to talk about bank errors, so it's just another reconciling item. But what I want you to understand is the balance for the bank plus deposits in transit, checks that we've got from customers that have that are on their way to the bank, and then outstanding checks are subtracted. That gives us the adjusted cash balance. Then we're going to look at the general ledger balance, and we're going to see if there was any interest picked up by the bank. Maybe there was interest expense. Maybe the bank made a collection on our behalf. For example, we might have a customer who sent the money directly to the bank on our behalf and not to us. Well, we're not going to know that until we look at the bank statement. And the bank always has fees and NSF checks, bounce checks. And we can have book errors like we talked about. We the 189 versus 198 thing on a check versus how it was written. And when we've done things correctly, Maria, the adjusted balance for the bank and the adjusted balance for the book gives us the balance, okay? Not memorizing here. Just I don't want to say common sense, but it's intuitive. The bank knows things that we don't. We have to add that or subtract it to our ledger. We know things the bank doesn't know yet. That goes in here on the bank side of the reconciliation. Then we have to write adjusting entries for the items that are on the book side. These are items where we have to write a journal entry. These are things the bank is telling us we didn't know. So you have journal entry responsibility on the book side. No journal entries here. Okay. Let's look at a bank reconciliation here, huh? This is your basic template. Basic template, it's the same for everybody, okay? Pretty much the same. We have a bank statement where it says we have $2,050, okay? But the book, our general ledger says it's 1,405. Well, that's a pretty big difference, huh? Let's reconcile. We start with the bank side. I recommend starting with the bank side because that's the easy one. All you're going to have to do on the bank side is add the deposits in transit and credit and subtract rather the outstanding checks. So let's see. Here's $140. It's a deposit we made on the 31st. We've got them in our books. We have to add it to the bank side. And they're giving you a subtotal there if you want to do a subtotal. Then we went through every check that cleared the bank and compared it to the checks that we wrote. we see two checks, check number 124 and 126, they were not cashed at month end. We have to subtract them out. And when we do so, we come up with an adjusted bank balance of 1845. Okay. Now we go to the other side. And the only reason I say the other side is a little bit trickier is that you can have various things. You have more types of goofs than you would have on the bank side. Okay. Not goofs, but reconciling items. The book balance was 1405. Remember, the bank was 2050. Well, let's see here. Look at this. The bank collected $485, maybe from a customer or maybe from somebody who borrowed money from us. Okay, we got $485 we didn't know about. Hey, we also have $8 in interest income we did not know about. So we record them up there and get a subtotal. The bank charged us $23 to print new checks. Okay, well, that's money we lost. We got to take that out as a subtraction. And we had one bum who wrote a check for $30 and the check was no good. Now we're finding that out from the bank. And thus we subtract that from the book balance. And what we come to is 1845, and we are reconciled. Okay? Bank reconciliations, super important. And now we have to write the necessary journal entries on the book side. Hold on here. They're saying bank reconciliation demo steps 1 to 4. We just went through the bank reconciliation. Now they're talking about steps 5 through 8, and I don't see any more steps. We balanced this thing. All we have to do now is prepare the necessary journal entries. And thank God, only items on the book side, only items reconciling the general ledger require adjustments. So what are we talking about? Well, the bank collected money for us. We didn't know about this. And it turns out it was a note. Somebody paid down a notes receivable. So that's money, that's found money. We debit cash, we credit notes receivable. There we go. We earn some interest. We debit cash and we credit interest income or interest revenue. On the other side, we had some reductions in cash. The bank charged us $23 to print new checks. We debit the expense and we credit cash. Bounce check, NSF check, non-sufficient funds. Well, when we processed that check, we debited cash and credited accounts receivable, right? Now we have to put the person back up on accounts receivable and go after them again. So we debit receivables and we credit cash, okay? Compute the day's sales uncollected ratio and use it to assess liquidity. Here is a little formula for you. Days uncollected. It indicates how much time is likely to pass before we receive cash receipts from credit sales. So the first thing is you only work with credit sales. If you have cash sales, you do not include them in this little calculation. We're going to take the average accounts receivable, divide it by the net sales, multiplied by 365 days. And that's going to give us a number. And in this case here, from Starbucks, their AR was 870, net sales 22.3. You divide that out, multiply by 360, it comes out to 14.2 days, 13 days, 14 days. It says here that Starbucks gets paid in 14 days. It takes Starbucks an average of 14 days from the time they bill somebody for their drinks and actually get collected. And what we're really talking about here is not the cash. 90% of what Starbucks does is in cash. And we're not really talking about checks either. We're talking about maybe Starbucks caters a party or something, or somebody makes a big purchase of 100 pounds of coffee or something like that, where Starbucks says you pay me in 30 days. That's what we're talking about. Jack in the Box, they have numbers that are a little bit longer there. Again, Jack in the Box, McDonald's, all those great restaurants, they deal in cash for the most part. But you could call Jack in the Box and say, I'm having a party at school here. Could you deliver 100 tacos and 100 hamburgers and 100 sodas, and we'll pay you in 30 days? Jack in the Box will do that for you. And that kind of thing they collect in 16 days. This is an important number, huh? The lower, the better. And that takes us to the end of this chapter. There's just a couple pieces in the appendix that I'm not going to talk about. And we go from there. You want to take a deep breath, Maria?
Yeah, that was a lot.
Yeah, it's kind of a dry presentation. We used to use McGraw-Hill, which had really good slides. We thought we really liked McGraw-Hill. And then a couple of the other teachers said Wiley book is better. So we went to Wiley, and my boss and I, Cornelia, we did not like Wiley at all for a lot of reasons. So we got permission to switch back to McGraw-Hill, but McGraw-Hill slides have changed to look like Wiley's. But they're still good. They're still usable. You have any questions on anything?
I don't. Thank you.
Hey, okay, we'll see. Hey, did you watch the Super Bowl?
I did a little bit. I was like doing homework and kind of watching.
Do that homework first. That's
Yeah.
important. Okay. We'll see you later, Maria. Bye bye.
See ya. Bye.